let's start big picture with the economy. I think it's on everyone's mind right now. From where you sit, what do you see in front of you right now?
Certainly, as we've increased rates to manage inflation and try to control the journey to a soft landing, we're seeing inflation has peaked and it's starting to come off, as you'd expect. We're seeing the impact of higher rates, taking a lot of cash flow out of and spending power out of our Canadians' hands, and therefore we are slowing the economy. You see spending trends at the consumer level coming off, all towards hopefully a softer landing later this year, where we expect inflation to be in that kind of 1% to 3% range. We think the Bank of Canada will have to raise a quarter point to finish the job, hopefully, and then hold from there. With that slower spending, you're seeing the Canadian housing market come off. Prices have come off, as you know, roughly 14–15% is our expectation. Demand is off almost 40% in housing activity. So far, an orderly slowing of the economy to get inflation under control. We do expect unemployment to continue to increase a little bit from the low of a 5% to roughly 6 to 7%. That's still, John, low in the overall scheme of an economic cycle. All that to say, we do expect a modest recession supported by still strong latent demand by the consumer, but also this enormous liquidity that we have in the marketplace, $300+ billion of cash sitting on balance sheets to absorb the shocks from higher rates, to absorb the shocks from any job loss that we do expect to see, and therefore supportive of a quick recovery. So that's our call. Economy strong employment. Higher rates will slow things down, but it should be a modest slowdown.
So lots to unpack there. It was basically a year ago where you were looking at the environment in front of you and even calling on our Bank of Canada to start thinking more significantly about raising rates. So in terms of where we are today versus where we were then, especially given the inflationary scenario, are you encouraged about how things have played out?
I am. I think if we had started a bit earlier, we might not have seen the peaks of rates, and it's harsh on consumers. I think we have to finish the job now, because if rates stay this high into late 24, late 25, the shock on consumers will be even higher, particularly those with mortgages. As they renew their mortgages in late 24, 25, the cash flow shock, the spending impact is more severe than what we're seeing in 22 and 23. So we do want to finish the job. We do have to get control of inflation. We're on that track, and therefore it's taken higher rates than any of us would have expected, 4.5% potentially, probably closer to 5% in the United States. But we're getting the job done, and we'll have to hold rates there for a while to make sure we got the job done on inflation, and then hopefully latter part of 24 you'll be able to start easing a bit.
And just to circle back on how the economy plays out from here, you painted a picture of a so-called soft landing, but the possibility of a recovery. Just in terms of the way by which things play out from here, walk us through the things you're most encouraged about that maybe get us away from that idea of something like a severe recession.
Well, as I mentioned, the liquidity in the system, it's unprecedented. We started pre-pandemic with roughly $40 billion of consumer liquidity, another kind of $30–40 billion of commercial corporate liquidity. That $40 billion today is equivalent to, pre-pandemic, is $300 billion today. So that latent liquidity can be used to spend and help the economy recover. The unprecedented amount of liquidity, almost 20% of GDP. So when you think about that latent spending power, it's very significant, stimulus for recovery.
And obviously the housing market, you made a reference to it. It's an interesting time. You talked about the level of household debt in this country. I think because of that, a lot of people, and you operate in the U.S. just as you operate here in Canada, they've looked at the economic roadmap for this country versus the U.S. and said maybe things could be a little more challenging. So based on your outlook, is that for both countries, or do you think because of that debt level in this country, it could be a bit more challenging for Canada?
Both countries have different dynamics at play. So we have greater liquidity here in Canada. U.S. liquidity is coming off quite swiftly. As you see the results of the U.S. banks, you see almost a third to half that liquidity has been consumed with inflation in the United States. There is different leverage levels, obviously. So part of it depends on how long and how high we have to keep rates to control inflation. If we're able to start easing in the latter part of 24, that will kind of re-inject consumer spending power into the economy, and that's quite important as well. We're also starting with such a strong base of employment, and we have a significant number of open jobs, somewhere between 800,000 and 1 million open jobs in the service sector, hospitality sector, manufacturing sector, and that rotation that we saw during the pandemic into the technology sector and the digital sector, you're seeing a rotation back now into the manufacturing and service sector. So we're starting with low unemployment, significant number of open jobs. That is inflation in its own right, and that helps us recover as well, the number of open jobs. So liquidity and open jobs and demand, it's an unprecedented economic scenario that we're trying to manage through.
It's also a time where one can reflect on where the economy is, where it might be headed,
Right.
but also what a country can be doing in terms of growing the economy, which is a subject you constantly weigh in on.
Yeah.
You know, in terms of the trajectory, what's top of mind for you? I mean, do you feel confident about the road ahead for Canada beyond just navigating through this economic storm right now?
Yes, you want to have stable policy, you want to have competitive tax rates, you want to have strong banking system, which we do have. You want to attract foreign and domestic investment into your country and capitalize on a number of the key thematics that we're seeing. We're seeing a lot of reshoring and nearshoring, particularly as we rethink our value chains and we rethink our production chains and rebalance globally. We still need global supply chains, but we're rethinking across multi-sectors, as you know, some of it driven by geopolitical tension, but some of it driven by how the world and consumers are changing. There's an enormous opportunity for Canada to capture these value chains. You see a number of moves into electric vehicles and trying to capture a bigger part of the automotive manufacturing value chain, and we've seen some very positive signals there, but you could extend it across a number of areas. How do we rebuild value chains in the manufacturing sector, in the agriculture sector, to continue to be successful in attracting investment and long-term jobs into our country? So we need to battle. Everybody wants that. You know, Mexico wants that. United States wants that. Europe wants that. It's a very competitive place. But we start with incredible talent in this country. We start with, you know, immigration that's been our core success factor, and a diverse and inclusive immigration in the country. All these set Canada up for very strong success. But now we need to be bold, and we need to make sure we attract those jobs and that investment and secure those value chains. And that's where business and government can really work together.
And at least for your business, obviously short-term uncertainties out there, but you did forge ahead with this sizable transaction with HSBC Canada, which was a business that, you know, wasn't necessarily a secret, that might be something that is available, but it's not every day that we see deals of that magnitude, at least of late in Canada. Mm-hmm. Can you walk us through what your thinking was, how that came together?
Well, HSBC's decision to exit Canada and presents an enormous opportunity for us to do a number of things. One, to bring two complementary organizations together to serve clients in an enhanced way. When you look at HSBC, it's a fantastic organization that has really strong, globally connected clients. They've built their products, their services, and their capabilities around a globally connected client. And that's complementary to what we have, which we're very focused on serving a domestic client, a Canadian client. So when you take the multi-currency accounts, the trade finance capability they have, the digital trading, global trading capability they have, moving cash, those are all really strong capabilities that we're going to build and bring into our core offering and offer to all Canadians. So bringing their client base, their core capabilities. On our hand, we've invested in a digital bank, very strong digital bank, online banking, mobile banking. We've invested in value, whether it's our Vantage accounts, our credit card lineup, our mutual fund lineup. We'll be able to offer all that convenience and value to the HSBC client as well. So when you bring these two organizations together, it allows us to aspire to be the premier organization in Canada serving globally connected clients, helping Canada grow, as we just talked about, in these new value chains. And you look at how we build those services. So it's really good for the HSBC client at the end of the day. It's good for Canada, to your point, because we'll be paying more taxes in Canada now. The enhanced profitability from bringing these two organizations together leads to a higher tax base for Canadians. we'll be paying dividends on that profit to Canadian shareholders. Those dividends on HSBC profits were paid to the HSBC global shareholder, small base of which I assume was in Canada. The majority of our shareholders are Canadian pension funds, Canadian retail investors, mutual funds. So we'll be taking that profitability and paying out 40 to 45% of that to Canadian shareholders. So the Canadian pension funds and Canadian investors are significant winners in this. And the last thing is we have committed to donating 1% of our profits to Canadian communities. So you take that profitability from bringing these two entities together, and it increases the donations in Canada. So when you look at the clients, you look at the communities, you look at Canadian taxpayers and the Canadian government, and you look at investors in Canada, this is a big win.
Helpful context on how that came together from your vantage point.
Yep.
There is an approval process.
There is, yeah.
Which are you confident as you forge ahead on that front?
Yeah, we see nothing here that changes the competitive landscape in Canada. No reason why the Competition Bureau should be concerned about this at all. Having said that, I can't get ahead of the Competition Bureau, and they'll run their process, and we'll work very closely in collaboration with them. But we operate in an incredibly competitive Canadian marketplace with over 50 banks, with hundreds of credit unions. It's a very competitive Canadian marketplace, and this transaction doesn't change that at all.
And yet, as I said, we don't see these kind of transactions every day. Arguably, one of the reasons why banks like yours have looked to other markets for continued growth over the years. One of the early deals in your tenure as CEO, City National, like a U.S. acquisition, and we've continued to see a lot of the Canadian banking players look to the United States. Can you just talk to us beyond Canada about your roadmap, if you will, for Royal Bank?
This opportunity with HSBC does not change our long-term ambition to continue to build out Canada and the U.S. and Europe, but the U.S. we call our second home market. We're very proud of the CNB transaction, the organic growth. We've been able to almost triple the CNB franchise. We still look for opportunities to grow inorganically through acquisition. We'll be delaying that for a couple of years as we focus on HSBC and executing that transaction. We're working on kind of enhancing the technology platform for CNB to be a growth platform for the future, but we still see allocating more capital in the future to the United States and the wealth, so serving affluent clients, high net worth clients, and commercial clients, entrepreneurs in the United States. That's our core kind of growth focus, and we'll be looking at acquisitions like CNB and our U.S. wealth platform. We're very proud of the progress we've made. We're the 6th largest wealth advisory firm in the United States. We're the 3rd largest wealth advisory firm now in the UK with the acquisition of Brewer & Dolphin. So as we continue to build out a global wealth platform and a global capital markets platform, you'll see us focus our capital on the United States and somewhat on Europe as well outside of Canada. But right now, executing the HSBC transaction is going to be all-consuming for us.
Speaking of the U.S., a lot of the chief executives there, as they're weighing in on the economic roadmap, are also just navigating things like the return to work. James Gorman of Morgan Stanley was making some comments recently about that. You have weighed in on this process of coming back from COVID. I would love an update from you on how you're thinking about that, what you've been communicating with employees, and what you're more broadly speaking or thinking about, at least when it comes to the idea of getting back to the office.
I think that there's room for both. That a hybrid world can be a more productive, more innovative world, more eco-friendly world, better world for work-life balance. But I think we're still in an imbalanced place. We've been encouraging and very open with our employees. Don't forget, a quarter of our employees in the world come in every day and deal face-to-face with our clients in branches, and we can't forget that. So we're talking about 3/4 of our organization that work in an office where they have the option to work digitally or in person. We find that when you talk about innovation, when you talk about building relationships up and down and across in the organization, when you build your culture, in-person work is really, really important. And we're trying to move that to 3 days a week, 2 to 3. I think we're probably at 2 to 3 right now. There is resistance, honestly. It's a difficult needle to move. There is particularly when you talk about middle management, where you have so many of your employees have families and have other responsibilities. They really want to balance their lives. You've got a lot of junior employees who want to come in, and you've got senior employees that want to come in. So it's really about connecting your organization and making sure we're on the same page at the same time, and therefore I do believe that a hybrid world has a strong in-person component to it. I mean, I see it every day in how you work, how you communicate. So whether it's 2, 3, or 4 days a week, I think we're on a journey to make sure that we're in half or more than half the time in the office place.
You use that word connection. When a business is as big as yours and you're looking to connect, you mentioned those people working at the bank branch. How do you go about doing that?
It's so important, John, to connect with the front line and connect with all levels of the organization. I put a lot of effort and time into it. I'll do visits into the regions. I'll have town halls. I'll have meetings with employees. I spend a lot of time talking to the front line and getting a feel for the organization and how customers are feeling. That investment is invaluable in understanding how your organization goes from strategy to execution to customer response. You have surveys and you see a lot of digital information, but talking to a frontline employee is invaluable in understanding how they feel about delivering services and how the customer responds and how they feel about the organization. I put a lot of time into that and travel to do that.
And obviously, when it comes to customers, and you talked about the entrepreneurs, you're the son of a small business owner. What would be your message to, in particular, some of those small business owners who themselves are navigating through what's going on right now? And we talked about the rate environment, which also creates some challenges.
Hang in there, and we're there to support you. Are having trouble finding employees to start. It's constraining their growth. It's constraining their ability to deliver their services. They're dealing with inflation on a number of fronts, in addition to higher rates. So it's a difficult time. At the same time, they've built up some liquidity to absorb that over time. You're seeing employees kind of rotate back into particularly the service and retail sectors we talked about. So things are looking better as far as rebalancing talent. Rates will come down over time. Some businesses have the ability to reprice that into their goods and services. Others are more constrained. So it is a more complex time for all leaders, whether you're running a large corporation or, to your point, running a small business. But it is a difficult time, and we're empathetic, and we spend a lot of time talking to our customers about their challenges. And then the next wave of challenges, how do we adjust to climate change? And how do you build a plan to reduce your carbon footprint? And that's the next phase that we're building up the capacity and the capability to how do you have that conversation with a small business? How do you help share our stories and understanding of what other businesses are doing and be that rock that says, here's how others are thinking about, let's share best practices, let's help you with that journey. So as we think about creating value for our clients, which is our core strategy, create value through advice, convenience, and core product and service value, that advice value is so important in the economic challenges, but also in the longer term transitions for climate.
And finally, journey, you talked about journeys. Your own journey, 2014, you took on this role. Does it surprise you it's almost been a decade?
It does. It's gone fast. We've achieved a lot more work to do, but I'm incredibly proud of the journey we've been on, how investors view us, how communities view RBC, #1 in customer service, how employees view the organization. When you look at all the stakeholders, and I have a 4-pillar scorecard between communities, employees, clients, and shareholders, and how we balanced that and driven the value of the organization, I'm incredibly proud of the decade, but a lot more work to do. And
do you still have that same fire in the belly from day one? I mean, you just talked about the roadmap for the next few years, but I guess on subjects like succession, does that cross the mind as well?
It's been working on succession from day one. It's constant dialogue with the board as you think long-term at all levels in the organization. I have enormous energy. I'm really excited about the future. I'm excited about where we are, the challenges from climate to digitization to AI technology. I'm very excited about the future.